On the call this morning, big gains in the S&P futures lead world markets higher as President Obama and congressional leaders reach an agreement to raise the debt ceiling. The U.S. dollar rallies while gold and silver fall despite a looming downgrade of the U.S. credit rating by S&P as lawmakers fall short of the $4 trillion in deficit reduction needed to keep its AAA credit rating. And HSBC, Europe's largest bank, is up 3% after reporting earnings above estimates, but the bank announcing it will cut 30,000 jobs by 2013. I'm Alex Steele, and the morning call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer with T3Live.com.
And I'm Alex Steele with The Street, and together we bring you a morning call. Very exciting day Monday, Scott. So here we are. We're seeing the relief rally on Wall Street that we've been waiting for with the debt deal. But I did read a note this morning that said that markets like the deal, but they never truly panicked in the first place. So there is no true reason for them to soar that much higher. What do you say to that?
Well, last week the market pulled in about 4%. We saw, a little bit of a correction ahead of what could have been a disaster. And it seems like right now they're just throwing that disaster down the road by putting together a deal that we just saw on TV. A few congressmen said they didn't even read yet. They saw the headline. They saw the headline saying, oh, we're close to a deal. So I guess everyone thinks it's just going to get signed. But at this point, I'm sure it gets signed. And then we have to just see the devil in the details later.
All right. So you think it's going to get signed. So then what's the strategy when you see the rally?
Well, on Friday, I wanted to look at the key moving average on the S&Ps. That was a 200-day moving average. So if you look right now at the chart, at the spiders, you will see what I'm talking about. Here we are. This is what held Friday. So this is what I care about. Here's the spiders. This is where we held the last time during that last crisis, the Japanese scenario. Actually, that was back here. But anyway, on the double dip fears. So Friday, my point of reference was a 200-day. We held it. It was a nice trade. Some that took some risk over the weekend and didn't really think that they wouldn't get a signature to the scenario are holding it. And now what I would want to do is look to see how we handle this 131 to 131.50 in the spiders. Can we have a strong day, Alex? A very strong day with some volume, with some participation, and do we close on our highs? That's what I'm going to be looking for today.
But in the meantime, though, while you're waiting to see how that plays out, how are you positioning yourself?
Well, I only took the trade on Friday. I didn't take it home because I'm not a risk taker, even though it was calculated that they would get something done. I'm coming in flat like a lot of traders out there. So I need to figure out today, what can I buy? What leading stocks can I turn to? Do we close on our highs? Do they fade this? Because you know what? I was on during the whole correction back in 2007. I saw when they bailed out Fannie and Freddie. I saw when they bailed out the automakers. And there were a lot of gap ups that didn't hold, and that led me to believe further weakness. So we need to watch today's action and the action of the next few days.
And not to be a big bummer over here, but we were talking about this before we started the show, and I'm of the point of view that wouldn't investors want to be selling into this rally after they got really pummeled last week when there's still so many negative news around? I mean, this does kick the can down the road, as much as I hate that phrase. I mean, this doesn't do anything to actually cut future spending. This is just about paying future bills, right? And not only the fact we had terrible growth numbers on Friday, I mean, for the first quarter was revised down to near recession levels, and we also had a really disappointing growth out of China today from the Purchasing Managers Index. I mean, these are things that are going to have to factor in, especially as we were anticipating a better second half of the year.
So there are a lot of headwinds. And what I would say to the investor, if you were jumping out of your skin on Friday with the market near the lows and you want to feel a bit more comfortable, I don't even care if we go higher. If you want to feel more comfortable, feel comfortable. We're up 17 handles. Sell some stock if you can't pay your bills and you're having troubles with your mortgage. You don't need to be in the stock market if you can't handle it. That's the problem with the country. Everyone lives above their means. If you could handle some of these ranges, and I do think that this range that we're trying to hold down at the 1255 or the 1285, which was the 200-day, if it stays intact with all those headwinds out there, we probably still make new highs in the year, but we need to watch this level to see if it holds. But no matter who you are, just be comfortable with the market. Don't trade outside your means or be overinvested if it's going to stress you.